the flow won't go where they want it to go. It's going to go into other asset categories. We think primarily it's going to go into gold and silver. Probably some of it will go back into Bitcoin at some point, though that's going to take a while to rebuild that market. And commodities are not temporary in the upside. They may look like it for the moment.
Michael Oliver emphasizes the importance of momentum in defining trend change. They explain that momentum usually leads price when it comes to trend changes, and that it can usually be seen on a momentum chart before it can be seen on a price chart. He also stresses the importance of being ahead of the game and identifying trend changes before others do.
We find that invariably at trend change points, tops or bottoms, that momentum will usually, almost all the time, lead price in terms of defining a trend change. In other words, breaking down or turning up. It'll usually happen on a momentum chart before it'll happen where everybody can see it on a price chart and get excited.
He also explains why it's important to look at all four major asset categories: debt markets, foreign exchange, commodities, with an emphasis on gold and silver, and the stock markets. The reason is that external factors from other asset categories can impact one's investments in a given market. He stresses, too, on the importance of looking at all four categories and being aware of how they can impact each other.
Right. Now, generally, we look at things on a fairly long-term basis. We don't care so much about the day-to-day. Now, we also cover all four major asset categories. Now, by that, the debt markets, foreign exchange, especially the large foreign exchange, dollar, euro, for example, commodities, but with an emphasis on gold and silver, and the stock markets. Now, why do we look at so many things? The reason is obvious, has been a long time obvious to us, that there are many times that if you're in a given market and focused on, let's say, a stock or a sector in the stock market, you've got to be aware that other icebergs are floating around out there, other asset categories. And it's not just what you think is going on with the stock market, but what's going on with the debt markets, foreign exchange, commodity prices. How will that impact your stock position? And those are external factors, but they're very real and very big. So you really need to look, no matter which market of those four categories you might be heavily invested in, at the other categories because they'll impact your category.
Michael Oliver talks about the Fed's influence and how the current topic of conversation is focused on what the Fed is going to do. He emphasizes that although the Fed can have one's back for some time, there are times when it can collapse in terms of its potency. Michael Oliver also discusses the importance of alternative markets, particularly gold and TBOs, as signals of large asset managers shifting their assets to safer places to be.
The topic of conversation right now is focused on the Fed as if Fed is God. And we know full well that, yes, the Fed can have your back for some time, but there's times the Fed totally collapses in terms of its potency. Witness 2000 to 2002 bear market. They did what they could to save it. It didn't help. 2007 to 2009, they did what they could to save it. It didn't help. And similarly, most bear markets start like arm wrestling. It's not real clear who's winning. If the Fed perceives and the public perceives and investor asset managers perceive that the stock market is risky, we better start moving assets to other categories, which they're already doing.
Michael Oliver reiterates the importance of looking at all four major asset categories and how they can impact each other. He also explains that although the Fed may create the river flow, it's ultimately the investors who divert the river flow to where they want it to go. Michael Oliver also discusses how large asset managers have begun to move their assets from one category to another, particularly to safer places to be such as T-bonds and gold, indicating a shift in skepticism and caution.
He's warned us, don't be so worried about the price of your stock. Worry instead about the value of your money. Guys like him who are not gold bugs have shifted assets, no doubt, not lots, but marginally, let's say, over to safer places to be. And I see the evidence now in what the bonds have been doing and what gold's been doing. So that indicates to me that large asset managers who are skeptical have begun to move slices of their assets from one to another. Now, if the stock market starts to get more overtly weak, you're going to have more of that because they got to go somewhere. And it's obvious that if they're buying T-bonds, they're not buying it for yield. They're buying it for safety. And they're buying gold because it's a leader of the inflation event. It led the commodities up 2 years before they even turned up. So anyway, I think that's going on. And that's another reason why you should look at all four asset categories. because they'll impact each other. Ultimately, the Fed may create the river flow, but investors as a class divert the river flow to where they want it to go.
Michael Oliver describes the bear market low of 2009 when the stock market was cut in half. He mentions that they got bullish on the very bottom week, not because they love stocks, but because technical analysis said that was the end. At that point, the river flowed that the Fed had already been created, but did not stop the big bear market.
Now, in 2009, at the bear market low, when the S&P had been cut in half, the stock market was arguably cheap. In fact, we got very bullish on the very bottom week. We said major low, not because we love stocks, but the technical said this is it. That was the end. At that point in time, then the river flow that the Fed had already been creating, but which did not stop.
Michael Oliver talks about how people bought the stock market and gold during the bear market low of 2009, but gold eventually peaked and went down in 2011, while the S&P continued to go up. They mention that the Fed printing money worked at that point because investors perceived less risk and greater reward.
Now, in 2009, at the bear market low, when the S&P had been cut in half, the stock market was arguably cheap. In fact, we got very bullish on the very bottom week. We said major low, not because we love stocks, but the technical said this is it. That was the end. At that point in time, then the river flow that the Fed had already been creating, but which did not stop the big bear market, went into play. And so people bought a lot of things. They bought the stock market and they bought gold as well. And for the next several years, gold went up more than the stock market. They were coincident at the time. But in 2011, they divorced. Gold peaked, went down, S&P continued on up. But at that point in time, it worked. The Fed printing money worked because the market had been cut in half. So investors perceived less risk, greater reward. But now we've been going up a dozen years and you have this upwardly curving chart off the page, one of the oldest bull markets in history, no doubt supported all along the way with easy monetary policy. But the question is, will investors and asset managers perceive this to be forever upward? Or are they smart enough to know, no, there's times that, the Fed doesn't control, because they look at history and they know. They were there in 2000, they know the Fed went down. We think we're at that point now. And I think that if the market starts to go down and they create even more river flow, or they simply continue what they're doing, the flow won't go where they want it to go. It's going to go into other asset categories. We think primarily it's going to go into gold and silver. Probably some of it will go back into Bitcoin at some point, though that's going to take a while to rebuild that market. And commodities are not temporary in the upside. They may look like it for the moment. Most commodities, they moved as an asset category, almost in synchronization, all exploding coincidentally: sugar, copper, oil. So the commodities all turned up coincident, meaning it wasn't peculiar to each market what caused the upturn. It was the monetary policy. And if the stock market wobbles now, it becomes a threat, that monetary policy is going to continue. And we still think it's going to go into the freshly upturned commodity category. Because when we measure commodities like the Bloomberg on an annual momentum basis, it only just broke out.